integrated disclosures. A copy of this presentation will be sent out to all participants within 24 hours and will also be posted on www.homebridgewholesale.com under the heading Working with Us. You can also view the recorded version on Homebridge's Google Plus account, also found on www.homebridgewholesale.com. We will be having a short Q&A at the end of the presentation, so feel free to ask any questions at any time in the question box on the webinar panel. So before we get started, I do have a couple of poll questions just to see who's with us today. So I am going to launch our first one, and it is, who has joined us? And if you could please take the moment just to answer the question. Okay, I'm going to have just a couple more questions. I'm going to spend just a couple more seconds on that. And I am going to close out. And I'd like to share with everyone. So here we are. We have who is with us today. And I can see a lot of brokers. So welcome. Our next poll question that I have is, how familiar are you with integrated disclosures? So please, if everyone can just take a couple minutes or a couple seconds and answer this as well. And then I will share with you the answers too. Just a couple more seconds. Okay, I'm going to close this out too, and I'm going to share with everyone. So it looks like we have no experts here, but that's okay because we do here at Homebridge Wholesale. And we can see we have some people that it's broken up really into thirds. Somewhat familiar, some just know enough to be dangerous about this topic, and then other people need to definitely learn and pay attention. So that's great. Thank you all very much for participating. So now, before we get started, I want to introduce Michael Grant, who is our National Sales Manager at Homebridge Wholesale. Michael?
Thank you, Pam. As everyone is aware, this is a very pressing topic, and the deadline is rapidly approaching. So we wanted to make sure our valued partners were well informed. This is just an initial step in the information process with another call to follow. So with that being said, I'd like to welcome our legal counsel, Phil Schill, who will be presenting today's webinar. Phil?
Thanks, Mike. Good afternoon, everybody. Good morning, depending on the time zone you're in. So I just wanted to start off with just a little counting for us. So 88 days, that's how far we are from August 1st. And I took the opportunity to break that down. So 7,603,200 seconds, 126,720 minutes, 2,112 hours. So I guess if you haven't paid attention yet to this, that's how much time you have to become an expert. And I think based on our poll, we currently have no experts. And while I've spent a lot of time on this, and while our legal and compliance group has been working on this since the fall, I think it's virtually impossible to say there are any experts on this material. It's quite vast, and we're going to jump right in. The goal of today's webinar really is an overview. For the folks who have a decent understanding, hopefully this will be reinforcing what you already know. For the folks who are just starting to, get versed in this information, hopefully this will, be the kind of the prompt for you to, to get educated and to really get up to speed, because 88 days, and that's calendar days, not business days, is really a short amount of time considering the amount of change that we're going to be dealing with. So first off, the industry, a lot of folks are referring to this as TRID, Tiller RESPA Integrated Disclosures Rule. TRID's just easier to say than the full-blown version and so forth. So for purposes of this webinar and for others, we'll commonly refer to it as TRID. So, we'll jump right in. As Michael said, these are significant changes, really the most striking changes in the industry in the last 30 years. The CFPB was mandated under Dodd-Frank to make amendments to RESPA and TILA to really make the primary disclosures for the consumer easier to understand, more transparent and so forth. And these take effect beginning with applications received on or after August 1st. So the first thing really is to start learning the names of these new disclosures. Okay, we have the loan estimate or the LE. This combines the initial truth in lending disclosure and the GFE. We have the closing disclosure or the CD. This combines the final truth in lending disclosure with the HUD-1. This little bullet here, I think, is probably the most significant bullet in the entire deck. It's not just about two new disclosures. There are vast changes in workflow. There are very deep implications to this, especially when it comes to the closing process. But as you'll see here in the overview, definitely not just about two disclosures. So we're going to get into these disclosures as an overview, and we'll talk a little bit about some of the changes and some comparisons to today versus where we'll be in August. Next slide, please. So we're going to start not at the very beginning, but definitely at the beginning. The very beginning would be when somebody's working with, a lead, a prospect. This is slightly after that, so we're at the point of application. The first significant change that is coming since 2010 when RESPA changed is that we are now going to have a uniform definition of an application, 6 items. As you will recall with RESPA 2010, there was a 7th item, a lender discretion or a catch-all item that anybody could basically apply to their processes and say that's when they have an application. Now there is no longer that opportunity. It's 6 items. When they're received in any form, verbally, written, or whatever, that triggers the application. That triggers the requirement for issuance of the early disclosure, the loan estimate. Next slide, please. Pam, all right, great. So we're going to talk just a little bit about the loan estimate. Our goal today is not to get into the real details of the form, just the overview of the information that's presented. And in the follow-up webinars, we'll get more into the actual form and the layout and so forth. So just the basic ideas, things that we're used to. We're combining, if you think about it, we're combining the goals of the GFE and the TIL. So the loan estimate is going to provide a consumer with the good faith estimate of costs of the transaction. And obviously it will be in writing, and there are specific information. It's broken up into 3 pages. Page 1, general information such as the applicant information, the property information, your loan, your rate lock status, your loan terms, projected payments, and so forth. And you'll see just by looking at those that those are combinations of items that are on either the GFE or the TIL today. Page 2 focuses on your costs. And if you think about it, the GFE today, the GFE also, today page 2 focuses on the costs. You'll see when you look at the LE that the layout and the presentation of that information is very different than what we're used to on the GFE. There are also changes where, particularly if you have adjustable interest rates or adjustable payments, where you have tables that will appear or not appear depending on the specific parameters of that loan. And then you also have other information. And this other information is much more detailed than what we're used to today, and there's some additional disclosure information. I want to point out here that on page 3 of the loan estimate, for a wholesale transaction, you will have both the lender and the broker's information there. And if you think about that today, none of the forms that we really deal with today, at least the federal forms, have both the lender and the broker listed on that form. So we can go to the next slide, please. So we'll talk about some of the differences and some of the things that are similar with the existing disclosures versus the new ones. So like I said, a lot of the same information. The format of presentation is very different. When you look at either the loan estimate compared to either the GFE or the TIL, the format, the layout is very different. The fonts are different. The way the information is presented is different. So one of the first takeaways from this session is that you need to think about retraining yourself to get comfortable with the layout of the form. If you think about it from a standpoint of being an originator or a processor or however you're involved with the transaction, when the consumer, wants to, kind of pick your brain about stuff, you need to know on the form where this information is. And it is different than what we're used to today. So that's critical. The form is laid out in a way based on CFPB research that lays out the, quote, most important information first. So based on market research and study and the goal of giving the consumer an easy way to understand their transaction, page 1 is, in their opinion, the most important information. And then also, as we go through the disclosure, information that was specifically mandated by Dodd-Frank is in there, and also things that, once again, based on market research, were to be for the consumer's benefit and so forth. Wanted to mention here that the APR, going from front and center on the till to literally page 3 of the loan estimate. Once again, I think for some people that will be a relief. I think having to explain to consumers and borrowers, what the APR is, what that means, why it's different than their note rate, has been a burden for years. We've come up with different burdens here, the CFPB is at least, but the APR is, while it's still important for calculations, for rate spread, for other types of analysis, when it comes to having to explain to a consumer, pushed all the way back to page 3. They're come up with a new figure, though, called the TIP, or the total interest percentage, and that's also on page 3. It's a large number, and you can see in this example, 69.45%. This is the total amount of the interest that the borrower will pay over the loan term as a percentage of the loan amount. So in our opinion, we've gone from having to explain the APR, and that's gone away to a certain extent, diminished at least, and now having to come up to explain what this large interest number is to consumers. Wanted to mention here that the LE has a place for the borrower to sign, different than the GFE today, but it does not indicate intent to proceed. So we are all used to since 2010 that along with the GFE, the borrower has to have an independent way to express their intent to proceed with the transaction. That is the case going forward as well. So whether it be a separate form or however that's done, we expect that will continue the same mechanism as we're used to today. Also wanted to mention that certain information that was prevalent on the till has been removed from the loan estimate. It's no longer being disclosed. You can go to the next slide, please. We'll talk about delivery of the loan estimate. The regime for this is similar to what we're used to today, from the standpoint of the GFE and the till. The creditor must deliver a place loan estimate in the mail not later than the 3rd business day after the creditor receives the consumer's application. Okay. If the loan estimate is not provided to the consumer in person, the consumer is considered to have received it 3 business days after it is delivered or placed in the mail. Wanted to point out here that throughout the discussions on TRID, we use 2 different definitions of business day. For simplicity, we refer to them as either the general business day or the specific business day. For the purposes here, for delivery of the loan estimate, a general business day is a day in which the creditor's offices are open to the public for carrying out substantially all of its business functions. So you think about it as an open for business day, which means that if you are the originator and you are taking this application, you receive 6 items as listed below. You have 3 business days on which you are open to deliver that loan estimate to the borrower. And that's pretty much it. So that's a business day that's really defined based on your day-to-day operation. Next slide, please. So as I said, when we started the application, we weren't really necessarily starting at the very beginning. So we're going to go back in time just a little bit here to talk about fees, restrictions regarding charging fees and so forth, and pre-disclosure. So similar to what we're used to, once again, from TILA 2009 and RESPA 2010, there are restrictions on what can be charged up front and when. So no fees may be imposed on a consumer in connection with the application before the consumer has received the loan estimate and indicated to the creditor an intent to proceed with the transaction. In addition, no payment information may be requested or held until intent to proceed is provided. So there is an exception for that, which is that for similar to what we're used to today, that if you charge up front for a credit report, you can still do that, the bona fide charge for a credit report, but that's the only fee that can be charged prior to issuance of the loan estimate and the borrower indicating their intent to proceed. Once again, in our opinion, the way in which disclosure and then fees are charged, the sequence of that is going to be different than what we're used to today. Fee charging is going to be, in our opinion, a distinct event in the life of the transaction. A lot of folks today, when they disclose to a borrower up front, they do an application package, maybe it's electronic, and if they're charging, let's say via credit card, they include with that a credit card form. You can't do that because you can't even have a mechanism for collecting a fee until the borrower has received that loan estimate and indicated their intent to proceed. The third bullet If the consumer is provided with a written estimate of terms or costs before receiving the loan estimate, certain specific requirements must be satisfied. We're not going to go into all the requirements, but wanted to mention that it's very common for folks to use a closing cost worksheet or a fee estimate up front when the borrower is shopping around. Okay, this is prior to the 6 items. And you can still do that. And when the GFE changed in 2010, a lot of folks used what the old GFE looked like as their worksheet. You can still do that. There are specific rules about what you can and can't do with that. We're not going to get into today, but there's a disclaimer that has to be on that worksheet. There's got to be some font things, and the bottom line is that fee estimate or that worksheet cannot be confused with the loan estimate. Last point here on this slide is that we may not require a consumer to submit documents verifying information related to the application before providing the loan estimate. So if you want to, pre-approve or pre-qualify a borrower and you want to require items, you can't require verification. You can't require a pay stub, a W-2, a bank statement prior to them, getting the loan estimate. And that's different than what we're used to today as well. Next slide, please. I'm going to talk about the concept of good faith here. It's listed as a new approach, and obviously the term good faith estimate's been around for a long time. But the idea in which what determines good faith is definitely getting more refined. So let's talk through this. The loan estimate figures must be made in good faith and consistent with the best information reasonably available to the creditor at the time disclosed. So how do we determine good faith? It's not a mathematical formula, but there is a formula for determining whether or not you've properly issued that loan estimate. We're going to look at the difference between the estimated charges originally provided in the loan estimate and the actual charges paid by or imposed on the consumer at the closing. Generally speaking, if the charge paid by or imposed on the consumer exceeds the amount originally disclosed on the loan estimate, it is determined to be not in good faith. That's the general statement, and as we'll say, there are some exceptions below regarding that. Note that this is true regardless of whether the creditor later discovers a technical error, a miscalculation, or an underestimation of a charge. Next slide, please. We're going to talk similar to the good faith. Now we're going to talk about when this actually works itself out at closing, where we're doing the comparison from what we issued up front of the loan estimate to what actually was charged when we go to the closing on the CD. So once again, in 2010, the concept of tolerance or variances was introduced. And that regime still exists going forward. There are a couple of changes that I want to point out. I'm not going to spend a lot of time on this because, once again, for most folks, this is something that we're used to today. Just wanted to focus on a couple of things. First, in the zero tolerance category. Okay, so once again, these are the things that we're used to today that are fees paid to the creditor, the mortgage broker, or in this particular case, an affiliate of either, period. We had to deal a lot with the questions about fees paid to affiliates or not when we had to start dealing with QM. So in this particular case, zero tolerance items are fees paid to either creditor, broker, or affiliate, period. Fees paid to an unaffiliated third party if the creditor did not permit the consumer to shop. That is new. Think about that as your block 3 charges on your GFE today. Okay, items where we require that borrower to use a particular service, okay, and they cannot shop for it. So a great example of that is a life of loan flood certification that we're going to get the vendor, or PMI. The borrower doesn't get to pick their PMI company, or MIP on a government loan. Okay, those are zero tolerance items. So that's new. The 10% cumulative tolerance category is similar to what we're used today. I say similar because it is not exactly the same, but it's beyond the scope of our discussion today. And subsequent webinars will get more into the idea of cumulative tolerance. And then the no tolerance category, which are the fees that can change pretty much freely, that's what we're used to today. Those are your things like your prepaid interest and your escrows and so forth, and items where the borrower is permitted to shop and then shops on their own and so forth. So that's it for this. Once again, it is a concept that we're used to from 2010, but definitely there are some changes to that as well. Go to the next slide, please. So now we're going to talk about revisions and corrections to the loan estimate. Obviously, we expect that throughout the life of the loan, things change. Okay, the concept of changed circumstance was introduced back in 2010, and it continues, all the way up through this with these changes in August. So as a general rule, the creditor is bound by the loan estimate and may not issue revisions because they later discover technical errors, miscalculations, or underestimations of charges. Creditors may only charge more than the amount disclosed when the original estimate, or lack thereof, meaning it wasn't part of the estimate, was based on the best information reasonably available at the time of disclosure. Before we talk about the revised loan estimate, when you can do a revision, let's go back up 1 second and look at that statement. Was the loan estimate provided based on the best information reasonably available at the time of disclosure? It's a very broad statement, but far-reaching implications. It ties into the entire concept of vendor relationships and vendor management, and having to provide borrowers with a geographic vendor for particular services for the various fees. And did you do a good job of doing that? Did you, overestimate purposely? Did you give a reasonable estimate? Did you account for all the fees that are common and customary in an area? Did you have a title estimate that was based in the reality of the transaction? Did you account for transfer taxes because that's what's common and customary and so forth? So there is a burden here with the statement that is far-reaching because, once again, we have the concept of cure, but we also have the concept of did you issue this in good faith? So wanted to mention it. It's not a throwaway. It's actually a very important item. So let's talk about revisions to the loan estimate. They can be revised when we have a changed circumstance. A changed circumstance that occur after the loan estimate is provided to the consumer that cause the settlement charges to increase more than permitted. A changed circumstance that occurs after the loan estimate is provided to the consumer that affect the consumer's eligibility for the terms for which the borrower applied or the value of the security of the loan. So an example of that would be loan to value change. Okay, appraised value comes in lower than expected. You have mortgage insurance that you didn't anticipate or a different factor on your mortgage insurance. That's a valid change of circumstance, as long as when we did the original disclosure, it was based on the best information available at that time. Third bullet is a big one, which are revisions requested by the consumer. The borrower obviously has freedom of choice here. If they want to change the structure of their loan, the fee structure, if they want to change the loan to value, their down payment, and so forth. The new changes here don't restrict the borrower from wanting to make changes. If the borrower decides that, let's just say in the wholesale context here that we have a loan placed with, wholesaler X, and based on their estimated closing date, they're concerned that they're not going to be able to reach their deadline on a purchase, and they may advise broker, hey, you know what, we need to move this loan somewhere else. That's a borrower request to change. And if that change, along with it, comes with certain changes to the transaction, once again, as long as it's documented the borrower requested, that would be a valid change. Similar to what we're used to today, we have an interest rate. If we go from a float to a lock, that's a valid change, and that obviously will set pricing at that point. Also similar to what we're used to since 2010. The borrower has a 10-day window to say, yes, I want to proceed with the transaction from the issuance of the loan estimate. That's the same as what they have today with the GSE. If they don't express their intent to proceed within the 10 days, then that loan estimate can be revised free will, with whatever changes the lender or creditor wants at that time if the borrower didn't express their intent to proceed. Another option here, and there's some carve-outs that deal with new construction and changes associated with the fact that you have longer processing time and so forth. Next slide, please. So the real definition of changed circumstance is very similar to what we're used to from 2010. For the purposes of issuing a revised loan estimate, changed circumstances are an extraordinary event beyond the control of any interested party or other unexpected events specific to the consumer or the transaction. We also have information specific to the consumer or transaction that the creditor relied upon when providing a loan estimate, and that was inaccurate or changed after the disclosures were provided. Or new information specific to the consumer or transaction that the creditor did not rely on when providing a loan estimate. So reliance is not the critical part here. The part here is that, was there a change in the information? And an example here would be, that we remember back from 2010, obviously the crazy ones, war, natural disaster, or so forth. But then you have more common things, an unexpected event specific to the transaction, the loss of employment, or some other change personally in the borrower's financial circumstances or their situation that will affect, their eligibility and so forth. So those are just some of the examples. And once again, I'm not going to spend a ton of time on this because it's similar to what we're used to from 2010. Next slide, please. Just want to give you a couple more additional notes on the loan estimate before we segue and talk about the closing disclosure. Okay, so the creditor is required to deliver or place in the mail a revised loan estimate within 3 general business days of a changed circumstance, including the interest rate being locked. And when is that interest rate being locked? What's the triggering event? That's when the lock is executed by the creditor. Next point, if a mortgage broker receives the consumer's application, either the creditor or the mortgage broker may provide a consumer with a loan estimate. If a mortgage broker provides a loan estimate, the creditor is still responsible for compliance. So more information about that is going to follow, because as an industry, this nuance here about how the dynamics of the issuance of the loan estimate via the broker or the lender, and ultimately how that process is going to flow, is still being worked out by a lot of folks, us included. Wanted to mention here that the alternative loan estimate may be used if the transaction does not have a seller. So there's a refinance version of the loan estimate. And also, number 4 is critical from a pipeline management standpoint. Creditors will still be required to use the current GFE HUD-1 and Truth in Lending forms for applications received prior to August 1st. So as the applications received prior to August 1st are closed, withdrawn, or canceled, the use of the GFE HUD-1 and Truth in Lending forms will no longer be used for most mortgage loans. And we say most mortgage loans because there are a subset of loans, reverses, and HELOCs and so forth that will still use the existing forms. But if we just talk about this for 1 minute before we move on to the closing disclosure, you'll have a pipeline of business that if it's disclosed under the current disclosure process, so if you have a file now, let's just say, that doesn't close until September, it will close using a HUD-1. If during the life of the loan after August 1st you have a change of circumstance, that change will be reflected on a GFE. If you have an APR variance, that will be reflected on a TIL. And those loans will close with a final TIL and a HUD-1. It is only that our applications received August 1st going forward that trigger the new disclosure requirement. And that's important when you think about having to coordinate closings and other things. People are going to need to know. Settlement agents are going to need to know, what are we dealing with? Am I dealing with HUD-1s? Am I dealing with loan estimates and closing disclosures? So once again, it is a simple statement, but once again, far-reaching implications when it comes to workflow, pipeline management, and so forth. And though it's beyond the scope of the slide, I want to mention this, that if you think about the concept of 6 items now, if you have 6 items today, not a 7th item, you have 6 items today, on August 1st, that will require the issuance of an LE. So you can have an 8-month-old prospect that you have 6 items, but they haven't formally applied yet. On August 1st, you now have to disclose that loan as a loan estimate. And that will be discussed furthermore in the additional webinars coming up. So now we're going to talk a little bit about the closing disclosure. So once again, closing disclosure is a combination of the final TIL and the HUD-1. It's going to be a form that is, once again, looks very different than what we're used to today. There are elements that look similar to the HUD-1, elements of the TIL, but the layout, the structure, all the conventions that we're used to are definitely different when it comes to the closing disclosure. So today, once again, we're just doing an overview. Basic page information, page 1 information is the general information, your loan terms, your projected payments, your cost of closing. Page 2 is the cost summary. So page 2 of the closing disclosure, very much similar to page 2 of the HUD-1. Page 3 is your cash to close and summaries. That resembles page 1 of the HUD-1. So we got some things that are out of order than what we're used to today. Then we have much more detailed additional information and other disclosure information. There's a comprehensive contact chart on page 5 that lists all the parties to the transaction with all of their relevant licensing information, addresses and contact and so forth. So it's much more detailed than what we're used to today when it comes to the information being given to the consumer. Also wanted to mention here that corresponding with the alternative version of the loan estimate, you also have that for the closing disclosure. So that's that. And then we can move on to page, next page, please. Just talk a little bit more about some of the details of the closing disclosure. And some of this I already covered in the description before. Critical thing here is that the goal really is for the borrower to be able to take that original loan estimate and put it side by side next to this closing disclosure and be able to see what actually changed. If you think about that today, to take either the HUD, a GFE and a TIL, and put it up against the HUD and try to figure out, what changed, it's very difficult. So one of the goals here is for things to be a lot easier for the borrower to be able to compare what happened. We also have some differences in the way that the costs are itemized. The column structure is different as far as the descriptions of the column and the timing. There's additional information in detail regarding cash to close and various calculations where various summaries are done. There's additional information for questions to be asked. So actually on the form it says if you have questions, you can go to the CFPB to help you, and also additional contact information. The form, the CD, has a signature page or a signature line similar to what we have today with the TIL. Last thing, this is just a reiteration here of the prior, that there will be this period of time where you have loans subject to both regimes, the pre-August 1st and the August 1st and going forward. Next slide, please. So we're going to talk about the timing and delivery requirements of the CD. This is critical. This is definitely, probably, when it comes to timing, the biggest change from what we're all used to. So let's go through it. A creditor is responsible for ensuring that the consumer, borrower, all throughout the regs it says consumer, consumer, consumer. Obviously, we're used to referring to our customers as borrowers, so we use them interchangeably. The borrower must receive the closing disclosure no later than 3 specific business days before consummation or closing, and we'll talk a little bit more about that. Let's talk about business days first. For the purpose of delivering the closing disclosure, a business day means all calendar days except Sundays and legal public holidays. Okay, so that's commonly, what we're used to also for the rescission counting. Okay, it's a specific definition. It doesn't make a difference when the creditor is open or not. It's Sunday doesn't count, and the specific federal holidays don't count in the 3 days. It's new. It will impact the scheduling of all closings. There is no doubt about this. If the closing disclosure is not provided to the consumer in person, the consumer is considered to have received it 3 business days after it is delivered or placed in the mail. Electronic delivery is probably going to be the way for everybody. If you're not doing it today, and if lenders aren't doing it today, this will be the way, most commonly, that things will be shared with borrowers in order to move these things as rapidly through the process as possible. A creditor may contract with a settlement agent to provide the closing disclosure on the creditor's behalf. However, in this case, the creditor is still legally responsible for the accuracy as well as any errors or defects. You're starting to hear a lot about there that closing disclosures will be prepared by lenders for this reason: legal responsibility and liability. So while the settlement agent is going to be an integral factor in the collaboration of preparation, there will be a change for many folks where instead of the settlement agent being the one actually preparing the CD like they're used to today with the HUD-1, it will be the lender. There can be an entire webinar just on that alone. The definition of consummation, is defined under Reg Z as the time that a consumer becomes contractually obligated on a credit transaction. Most commonly, that's when the date the note is signed. So you hear the term consummation, but we think about it when the borrower signs the note. Last item here, the settlement agent must provide the seller with the closing disclosure. So the way this is set up, LE and CD are borrower documents, lender responsibilities. It's very geared towards the borrower. There is a form of the closing disclosure for the seller, but it is the settlement agent's responsibility to deliver that to the seller. We'll talk about, next slide please, the revisions and corrections to the closing disclosure. Generally, creditors must redisclose terms or costs on the closing disclosure if certain changes occur to the transaction that cause the disclosures to become inaccurate. Some of this is what we're used to today. So let's talk about what does inaccurate mean. There are 3 items that occur that will affect, and trigger a new 3 business day waiting period. The first is if the disclosed APR becomes inaccurate. There is a slight typographical error on the slide, I must say. It's an 1/8 up or down for fixed, just as what we're used to today, but it's also an 1/8 up or down for most ARMs. It's irregular transactions that have a quarter variance. Most ARMs are not irregular transactions that has a specific definition. So it's not quite typo, but that's not exactly stated properly. So for all practical purposes, for most programs and for the programs that Homebridge offers, you're talking about an 1/8 up or down. We'll get into the up or down at a later date as well. If the loan product changes, so that also has a specific definition under these new rules. And we're talking about, in most cases, when you're going from a fixed to an adjustable, or an adjustable to a fixed, or within the types of adjustables. Those are product changes. So that will be something now within LOS systems and within brokers to lenders where there has to be consistency about the loan program and the understanding of the loan program, because potentially, if at very late in the transaction there is a change, and I'm talking late, meaning the closing disclosure has already been issued, and if there is a product change, then that would require a new 3-day waiting period. And if there is a prepayment penalty added. Now, Homer doesn't offer any products with prepayment penalties, but if one at the very last minute, was added, then you'd have to trigger a new 3 days. There are multiple changes that do not require 3 new business day waiting period. I think when this rule came out months and months ago, people got concerned that, variations that occurred because of, stuff that was out of our hands, items at a walkthrough or a homeowners association dues change or a fee or something like that. All those things need to be updated on the closing disclosure, and a new one needs to be reissued, but it does not trigger a new 3-day 3 business day or specific business day waiting period. That's critical. And then also certain changes that occur after the fact. If certain things that occur, subsequent downstream, recording and other things, that it comes back to the lender that the information on that final CD is wrong. Maybe it's no tolerance issues or things like that, but when it comes to accuracy, that closing disclosure would need to be revised. The consumer has the right to inspect a revised closing disclosure during the business day before consummation. That's the same as if it is with the HUD-1 today. So we're going to wrap up. We have a couple more slides. We'll talk about curing tolerance violations. Not going to spend a lot of time on this. Once again, it is similar to what we're used to since the 2010 RESPA changes. As a general rule, if the amounts paid by the consumer at closing exceed the amounts disclosed on the loan estimate beyond the applicable tolerance threshold, the creditor must refund the excess to the consumer no later than 60 days after consummation, and also provide the borrower with a corrected closing disclosure. The zero tolerance charges, once again, the items that were used to the broker and the lender paid charges and the affiliates and so forth. Any amount charged beyond the amount disclosed on a loan estimate must be refunded to the consumer. Once again, we're used to that today. The 10% cumulative tolerance charges, to the extent the total sum of the charges added together exceeds the sum of all such charges disclosed on the loan estimate by more than 10%, the difference must be refunded to the consumer. Similar to what we're used to today. So, talk about what's next. Next slide, please. Once again, when we started this a half hour ago, this is a general overview presentation. We packed a lot of information into this so you can, hopefully the wheels are turning. You're starting to ask yourself questions and so forth. But there's a lot more material that we will be distributing to you. And once again, as Mike said, we'll be doing some additional webinars and so forth. I said it back in the beginning. It's not just about 2 new disclosures. Hopefully, presentations like this one are getting people to that point of realizing there's a lot of things to think about. There's a lot of details that are very specific to each organization as to how they're going to operate. Okay? We will be seeking input from our broker partners. We have to figure out workflow. We have to figure out the relationship, the dynamics, and so forth. We do not want this to be an inhibition to business. At the end of the day, these disclosures are good for the consumer. They are. You can say whatever you want about process, about change in the industry, and so forth. At the end of the day, these are easier to understand. There is no question about it. But getting there is still going to be definitely a challenge. It's a big rule. For those who haven't paid attention, almost 1,900 pages. There's a lot of different changes within LOS. For all the folks here, with your various LOS providers, we know from who we work with, they've been working literally around the clock trying to get ready for this. But there's a tremendous amount of work to be done. There will be a tremendous amount of time needed to, A, get your systems updated, and B, train your staff. So those are big takeaways from this as well. But you can't do that until you have a fundamental understanding of the concepts. So additional resources is our next page, some things to talk about. The CFPB implementation page is chock full of information. There are tons of guides. There are samples. We disclose some of the samples here for you as well. There are explanations how to fill out forms. There is a very detailed PDF on the calendar, and all the timing requirements that we talked about today, understanding the differences between general and specific business days and so forth. So get educated. There's a lot of information out there. And I think at this point I'm going to turn it back over to Pam.
Thank you very much, Phil. We did get a lot of questions, so thank you. Please continue to put your questions or any questions you have in the question box on the webinar panel. We're going to try to get to some of these. I know because we have so many questions that came in, we're not going to get to them all. And I do want to make sure that we end on a timely fashion, so I'm going to start. So we got a question, how will broker paid compensation and lender paid compensation be disclosed?
Okay, so I think the question was probably borrower paid compensation and lender paid compensation. So there's one significant change here when it comes to the loan estimate, which is that lender paid compensation is not anywhere listed on the loan estimate. So that is a big difference than what we're used to today. It is listed on the closing disclosure, but is not issued on the disclosed anywhere on the loan estimate. And that's actually for brokers a pretty substantial win, if you want to talk about it. For a long time, there was concern that brokers were being unfairly, kind of picked on because lender-paid compensation was being disclosed to, having to be disclosed. Meanwhile, bankers and so forth didn't have to disclose their, their gain on sale, their secondary market profit, and so forth. So this is a situation where the disclosure actually benefits brokers. If there is a fee being directly paid by the borrower, points, origination, and so forth, those are disclosed just like they would be today. That's part of, the origination charges and loan cost section of the loan estimate.
So we got a follow-up question just to make sure everyone's clear. The question is, since I'm a broker on the LE that comes up before an application, do I still have to show my yield spread premium?
Well, the answer is no, okay? And let's be clear also, yield spread premium, as much as we still like to call it, is really kind of an outdated term. It doesn't really exist really in this regime anymore. But the bottom line is that any compensation paid by the lender to the broker is not disclosed on the loan estimate.
Great, thank you. What about lender credits and seller credits? Are those itemized?
Yeah, they're itemized on both forms, okay? So on the loan estimate, on page 2 of the loan estimate, there is a line item specifically for lender credit. There also is a line item specifically for the seller credit. And basically, from our understanding with the loan origination systems, is they handle it differently, but there are itemized fields on the loan on the LOS for those to be detailed, itemized, and they roll up into these forms. And that's the case for both the loan estimate and for the closing disclosure.
Okay. Who's going to prepare the loan estimate on wholesale transactions? Would that be the originator broker or the lender?
I think it's going to be both, meaning that depending on the particular lender and the particular broker, there's going to be some, some decisions that have to be made there. There will be some lenders who require that they are the ones responsible for it, and others will allow the brokers to basically issue it. At the end of the day, as mentioned in one of our slides, that if a lender accepts that loan estimate that's been prepared by the broker, then once they accept it, they're bound by it. The difference that we have today is that, the TIL is really a creditor document that is not triggered until the lender receives the application from the broker. But here, if you think about it now, the origination within 3 days, regardless of who originates that transaction, the loan estimate has to be issued. We can wait and hold off until we get it to the lender in a wholesale transaction. So I think it's going to be, the next 88 days, we're going to figure that one out.
Great, thank you. Couple more questions. What's the difference between a 3-day waiting period from disclosures today to the new 3-day waiting period, and can that waiting period be waived?
All right, I'm going to answer it in a couple different ways. We'll talk about loan estimates first. Once again, very similar to what we have today. The difference is that we don't have two distinct disclosures being issued. We have the combined, the closing disclosure. So, it's one disclosure that's issued within 3 days of application. So you can pick it whether it be based on your GFE or your TIL. It's not really different. The only difference here is that it's only one issuance as opposed to the split disclosures. When it comes to the closing part, the 3-day waiting period for the issuance of the closing disclosure is new. We do not have an equivalent of that, for that today, and that applies to everybody. Waiver is a slippery slope. There are waivers that are out there for various types of laws like this and other ones, but generally speaking, most people do not allow the borrowers to execute waivers because there is some liability that comes along with that, and we expect that will be similar. There's definitely some concerns in the secondary market about transactions when there's been a waiver of these particularly important disclosures.
Okay, we have only time for one more question, and someone asked, what's the #1 action that someone should take personally to share with their real estate clients?
I think the most important thing right now is to get educated, and because you need to set expectations. I think the biggest difference with this is that, the workflow of the transaction is different. The timing is different from the very beginning. Expectations are different from the very point of pre-qualification, all the way down through the closing. And I think that especially for customers who have closed, prior to this, they're used to a certain thing. Certain timing, certain rules. I think for those folks who do a lot of purchase business and work with realtors, the timing in which you're setting up your closing, if you have multiple transactions hinged on it, domino transactions, where you do your walkthrough that morning and then you do your closing, those time frames are going to change. So I think, once again, the biggest thing is to get informed, educated, understand this stuff. And I think the other thing is to participate in other webinars and outreach and getting the word out to folks, because on August 1st, it is going to be different, and right now I think people are coming to that awareness. So that's my takeaway from that.
Great. Thank you so much, Phil. I do appreciate it. Michael, are you still with us?
Yes, I am.
Great. I'm going to turn it back over to you.
All right. Thank you, Pam. So in closing, you guys, I want to thank first and foremost Pam Seifert, our training director, Phil Shield, our legal counsel, and all of you guys for joining today's webinar. Hopefully you found it informative. Please look to get our next invite for, it should come out sometime later this month, for next month's series in this webinar process. So again, thank you for joining us. Have a great day, and we look to talk to you guys soon.